welcome back to Cash Flow Confidence. I'm Shelby Ashley, and I help business owners feel more confident about their cash flow.
So if you have ever looked at your profit and loss statement and thought, oh boy, it looks like I made money, where the heck is it? Then this episode is going to be for you. Because this is one of the most confusing parts about running a business. And if you've ever thought to yourself, well, I had a great month, but why can I still not afford to pay myself? Or my accountant says that I'm profitable because I owe in taxes, but I feel super broke. Like I don't even have the cash to pay these taxes. Or I thought I was doing really well, so why does my bank account say otherwise? Then this is for you. So I'm going to break down why profit and cash flow are not the same thing and what you actually need to look at if you want to feel more in control of your money, and not just on paper, but in real life as well. So I just want to start by saying your profits are just what your reports say. Like your profits exist on paper only. It's a math equation. It's all of your revenue minus all of your expenses. Your cash flow is what your bank account says. And those two things are not always in agreement, especially if you are an accrual-based business, which most of us are. So profit, like I said, is calculated like revenue minus your expenses. But it doesn't capture where your money actually moves. So let's say you close like a huge deal in 1 month and you invoice that client for $10,000, but they don't pay you until like 2 months after that. Well, that $10,000 is still going to show on your profit and loss statement because you invoiced it in whatever month, say like this month, August. Even though they don't actually pay until 2 months from now, it's still considered profit. And so it's going to show up on your profit and loss, but it's not going to show up in your bank account until they actually pay. And so your accountant's going to log it, your profit margin's going to look amazing. Meanwhile, your bank account is still going to sit empty and you're going to be stressed out. So there's the gap. Profit is what happened on paper. Cash flow is what actually came in and what actually went out. So you cannot pay your employees with just profit. Like if you invoiced all the money in the world, but your clients didn't actually pay yet, you can't make payroll because the cash isn't there. Your profit is really just something that tells the IRS what you're going to owe in taxes. Like the IRS does not care if you collected on that profit or not. It just says, oh, you were profitable. Okay, here's what you owe. Good luck writing the check, pretty much. Your cash flow is what actually hit the bank. And so the disconnect is because there are several transactions that don't show up on the profit and loss. And the first of those, and probably the one that trips people up the most, is outstanding invoices or accounts receivable. So if you are not diligent about collecting on your outstanding invoices, yes, the profit will be there and it's going to look, super amazing that you made all this money. But if they haven't actually paid the invoices, then the cash isn't going to be there. And so you need to make sure that you have at least, depending on the kind of services that you offer, make sure that you are at least enforcing net 30 terms. I mean, due on sale is awesome, but some businesses, if your work kind of spans over a period of time, due on sale isn't probably the best. But if your terms are, let's say, net 30, then when that 30 days is up, those clients need to be paying you. And if they're not, then you need to have a process in place that says, okay, they're late by X amount of days, so they're going to get a phone call. They're going to get automatic reminders. A lot of invoicing software these days kind of takes care of that for you. So I know it can be uncomfortable when clients are late and you have to email them or call them and let them know, and you're afraid of, tarnishing that relationship. But utilize these automatic features that a lot of invoicing software take care of for you. Like they'll send email blasts, and some of them will even send out text message reminders or however you want to handle it. Bottom line, don't let your invoices go too late. Another place that your cash might be tied up is like your days payable outstanding. So the complete opposite of what I just said. When you have to pay your suppliers, you have booked the expense because the bill came in, but you haven't paid that bill yet. So like the expense is there, the expense itself is going to show up on your profit and loss, even though you have not paid that bill yet. You want to make sure that you have very good relationships with your suppliers so that you can have good terms with them. That way you can take advantage of, net 30 and net 60 terms, especially if you're in the trades. Home Depot, Lowe's, Grainger, they're going to offer you net 30 or net 60 terms so that while you get billed, you don't have to pay it for 30 days. And that gives you time to collect on the clients that are owing you, right? Because you don't want to be in a spot where you owe your vendors immediately, but you haven't even gotten paid for that job yet. That's not a great spot to be in. So take advantage of any terms that your suppliers are offering you and don't pay any earlier than you have to. If it ain't due for 30 days, there's no reason to pay it tomorrow. Now, if you know that you're going to be in a better cash spot tomorrow than you will 30 days from now, then yes, that's a strategic decision that you might want to make. Pay when you're able to. Another place that cash gets tied up that's not shown on the profit and loss statement is owner distributions. So your payroll will show up on the profit and loss. Like whatever you're paying yourself through an actual payroll system, that gets expensed as your payroll expense. But if you're just using a company credit card to, put gas in your car or buy a meal, or you're taking your quarterly distributions or whatever frequency you take distributions from, that does not show up on the profit and loss. That is a distribution. It is just pretty much a bank transfer from your business to your personal checking. It's not going to show up on the profit and loss. And so if you are taking distributions more often than you probably need to, that's going to show up like, oh, I made a ton of profit, but I pretty much drained my business's bank account. You don't want to do that. You're going to put yourself in a really tight spot. So watch your owner distributions. Another place that cash is going to move aside from the profit and loss is any debt repayments. So when you take on debt, that's going to be a cash influx. That's not going to show up on the profit and loss. That loan that you just took out or whatever it is, that's going to show up as all this money in the bank, that's not going to affect your profitability. When you start to pay that loan back, the interest will affect your profitability because we expense interest, but the actual principal payment will not. That's just money moving outside of the profit and loss. So I was talking to a business owner one time who he had gotten into a really bad spot because I think I mentioned this on our earlier podcast episode as well, but he had this loan that he really wanted to pay off. And so he was finally in a good cash position to do so. He was very profitable and he thought, okay, I'm going to tackle this loan and really get it paid off because somebody had given him advice that whatever he pays off on this loan is going to basically eat away at his profits and kind of get him out of paying taxes on his high profitability from that year. Well, it did not, because loan payments themselves do not affect your profitability. So he pretty much drains all of his cash paying off this loan, but his profit is still there. Like he's still, I think he was like 23% profitable or something. It didn't affect that. So he still owed taxes, but he had just spent all his cash paying this debt off. Now he's got to write a check to the IRS and he's like spent all of his cash. So don't put yourself in that kind of position. Just know that whatever debt you take on or debt that you pay back is outside of the profit and loss. Except for, the little tiny amount that's the interest portion, but that's not going to be enough to, put you in a bad spot profitability-wise. Another place that cash moves outside of the profit and loss is inventory. And I won't get like too deep into this because I try to not sound like an accountant as best I can on this podcast. But yes, there are certain inventory transactions that are not captured on the profit and loss. You can, if you Google days inventory outstanding, you can get, a more, accountant level description of it. I don't typically work with a lot of clients that carry inventory. It's not totally off the table, but it is something that can get really confusing really fast. So I'm not going to go into it really deeply here. But yes, it is called days inventory outstanding. It is a metric that measures cash outside of the P&L when it comes to inventory. So with all that being said, a lot of business owners watch their profitability like crazy and they kind of just dismiss the actual cash flow portion. Yes, your profitability is a measure of how healthy your business is and how well it's doing, but it's not the end measure. You can last years without making a profit, but you cannot last a day without cash. And I always like to say that your profitability is like your speedometer in your car. So it tells you how fast or how slow you're going. You could even be going backwards, and suffering a loss. But your cash flow is the gas in the tank. So if you don't have any gas, you're not even going to leave the driveway. You can have all the profitability in the world and not have any cash. And on the flip side to that, you can have negative. You could have like shown a loss that year and made, a whole bunch of cash. I've seen that happen with clients before. So your takeaway from this episode is to make sure that you are keeping an eye on your outstanding receivables. So at least weekly, watch what invoices have not been paid and keep up with it. Call on people that have overdue invoices. You are not going to, negatively affect your client relationships. You are not their bank. Make sure that they are paying their invoices on time and, adjust your terms if you need to. If you find that you're getting in a bad cash spot each month because these clients aren't paying enough or on time, then, adjust your terms if you need to. Watch all of your cash outflows. So make sure you are not spending the money before the money comes in, okay? Make sure that you are utilizing your terms that your suppliers have given you. If they say it's not due for 30 days, then don't pay it, tomorrow if the money isn't there. And then finally, watch your owner distributions. This account gets ignored. I mean, probably more than anything else is the owner distributions. It can sneak up on you so quickly. So if you've got a company credit card and you find that you're using it pretty often for personal things, put it somewhere where you can't really access it quickly. If you've got it for materials or things like that, make sure it is only used for those business-related things and stop using it for gas, meals, things like that. So again, just to emphasize, don't only look at your profitability, don't only look at your revenue, look at your cash flow as well. And if you need help with this, kind of bridging the gap between what your profitability says and what your bank account is saying that's totally different, please reach out to me because this is exactly what I help people try to understand and really get a hold on. So, okay, see you guys next week.